Warren Buffett just released his 13F filing for the third quarter of 2023. This filing shows all of the stocks he has been buying and selling in the third quarter. In this quarter's filing, it was revealed that Buffett has been selling a lot of his stocks. In fact, he sold a total of 13 stocks in the quarter, of which he completely sold out of 7. He only purchased 4 stocks in the quarter as well, and they were pretty insignificant buys. Therefore, it looks like Buffett has been a net seller of stocks and has gotten rid of many of his positions. In this video, I want to discuss why Buffett is selling off so many stocks by explaining his investing process and how he values stocks in the first place. By understanding his methods, you'll be able to understand the reasoning behind these sells and become a better investor yourself. Additionally, Stock Unlock will be sending out a free newsletter tomorrow morning on a high-quality business that is selling 30% below its all-time highs. This newsletter will explain the business, its price today, and why it could be looking attractive in the stock market right now. So if you're interested in receiving this free newsletter and learning more about identifying high-quality stocks, then you can sign up over at stockunlock.com. The link will be in the description as well. With that being said, let's dive right into the video. Let's begin by taking a look at the bottom 4 stocks that Buffett has completely sold out of, which are Johnson & Johnson, Mondelez, Procter & Gamble, and UPS. All of these are strong American brands that have been around for decades. They are also all dividend-paying businesses that, well, pay dividends. Additionally, they are all selling for price-to-free cash flows of 22 or higher right now. This means that their free cash flow yields are all around the 4% range. Now, if we take a look at the 10-year bond yield, we can see that it is now sitting at 4.4%, which is above the free cash flow yield that Procter & Gamble is currently offering. Bond yields have been rising rapidly with interest rates, and they're now at a point where they're offering higher returns than many stocks in the market. The Intelligent Investor, which is the book that heavily influenced Warren Buffett's own investing, says investors should always compare stock yields versus bond yields. If stock yields are lower than bond yields, it means you're being less compensated for taking on more risk. Or in other words, you could be getting a higher risk-free return by buying bonds instead. In fact, Benjamin Graham, who is the author of The Intelligent Investor, would say that if a stock's yield is below a bond yield, then it is overpriced and has no margin of safety. And by the way, I have a series on my channel that goes through The Intelligent Investor chapter by chapter and explains all of this if you want a deeper understanding. But now that bond yields have spiked to above the yields these stocks were offering, it looks like Buffett has sold them and moved the money into bonds instead. By doing so, he is getting a higher risk-free return on his money. On Berkshire's recent third quarter report, they showed that they have $126 billion invested in bonds now, which is up $34 billion year over year. This is compared to a $10 billion increase in investment in stocks, which also includes price appreciation. In conclusion, it looks like Buffett has moved a significant amount of Berkshire's capital into bonds instead of stocks. Additionally, Berkshire's investment income is up $1 billion or 75% year over year. In their explanation, they say that the investment income increase was primarily due to higher interest rates on bonds, and partly offset by lower dividend income. In their investment income breakdown, you can see their dividend income has declined by about 4.5% year over year, which suggests that they have sold off dividend-paying stocks. Their interest and investment income, which is their returns from bonds, is also up 330% year over year. This all suggests that Berkshire is selling some of its dividend stocks to buy bonds instead. In fact, Berkshire writes that its dividend income is down due to its disposition or selling of investments. Its interest income is up due to higher interest rates and an increased investment in bonds. This confirms that Warren Buffett has been selling stocks and putting the money into bonds instead. And I think it's pretty clear that he is doing so because bonds are offering higher yield than those select stocks are currently. In 2001, Buffett was answering questions at Georgia University and was asked how he finds intrinsic value in a stock. And listen to how he answers this question.
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal, So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those. Number two.
So you got formulas involved in finding intrinsic values on certain companies. I mean, you've got a mathematical system set up.
Discounted present value of future cash, yeah.
Okay. Second short question is, why haven't you written down your set of formulas or your strategies in written form so you can share it with everyone else?
Well, I think I actually have written about that. If you read the annual reports over the recent years, in fact, the most recent annual report, I use what I've just been talking about. I use the illustration of Aesop. Because here Aesop was in 600 BC. Smart man. Wasn't smart enough to know it was 600 BC, though. I mean, would take a little foresight. But Aesop, in between tortoises and hares and all these other things, he found time to write about, birds. And he said, a bird in the hand is worth two in the bush. Now, that isn't quite complete, because the question is, how sure are you that there are two in the bush? And how long do you have to wait to get them out? Now, he probably knew that, but he just didn't have time because he had all these other proverbs to write and had to get on with it. But he was halfway there in 600 BC. That's all there is to investing, is how many birds are in the bush, when are you going to get them out, and how sure are you? Now, if interest rates are 15%, roughly, you've got to get two birds out of the bush in 5 years to equal the bird in the hand. But if interest rates are 3%, and you can get two birds out in 20 years, it still makes sense to give up the bird in the hand, because it all gets back to discounting against an interest rate. Problem is, often you don't know, not only how many birds are in the bush, but in the case of the internet companies, there weren't any birds in the bush. But they still take the bird that you give them in the hand. But I actually have written about this sort of thing, and stealing heavily from Aesop, who wrote it.
In this clip, Buffett says the number one question to answer is how much cash the investment is going to give you versus the price you pay for it. He also says he thinks about every single investment this way, whether he's buying stocks, bonds, real estate, or anything else. He also says you have to compare the rate of return on the cash against what interest rates currently are, because they set the bar for risk-free returns. For example, if bond yields were 15% today, and a stock was yielding only 3%, then why would anyone want to own the stock when they could get a much higher return risk-free in bonds? Additionally, if a stock's yield is 15% and a bond is yielding 3%, then why would anyone want to own that bond over owning a stock instead? So depending on what bonds are offering, it can change where the best investment opportunities are and how investors should be investing their money. Buffett also says he wrote down how he values stocks in Berkshire's 2001 letter to shareholders. I went and found the writing he was referring to, and here it says, "Leaving aside tax factors, the formula we use for evaluating stocks and businesses is identical. Indeed, the formula for valuing all assets that are purchased for financial gain has been unchanged since it was first laid out by a very smart man in about 600 BC. The oracle was Aesop, and his enduring, though somewhat incomplete, investment insight was, a bird in the hand is worth two in the bush. To flesh out this principle, you must answer only three questions. How certain are you that there are indeed birds in the bush? When will they emerge, and how many will there be? What is the risk-free interest rate, which we consider to be the yield on long-term US bonds? If you can answer these three questions, you will know the maximum value of the bush, and the maximum number of birds you now possess that should be offered for it. And of course, don't literally think birds, think dollars." In the shareholder letter, Buffett once again uses the bird in the hand analogy and tells investors that investing requires three different questions. How certain are you that there is a bird in the bush? Which means, how certain are you that the business will return cash to you in the future? How long will it take to get the bird out of the bush? Which is the return rate on that investment. And what is the current risk-free rate, which is the rate of return your investment must beat to make the investment worthwhile in the first place? The investments Buffett has sold do not pass the third question of this analysis, which is once again that they do not offer higher yields than the risk-free return on bonds now. Therefore, the investments that Buffett has sold off seem to be more so him moving capital to where he believes it will get the best returns. Additionally, Buffett now has 73% of Berkshire's stock portfolio invested in just 4 stocks, with Apple being 50% of Berkshire's entire stock holdings. Buffett still seems bullish on these stocks despite everything going on in the market, and most interestingly, he is still holding on to Bank of America, despite all of the drama in the US banking sector over the past year. Bank of America is still in a 40% correction from its highs as well, and trading near its historical low price to earnings ratio, which could suggest that the stock is looking undervalued right now. But that is going to wrap up the video for today, everyone. And if you did enjoy this video, then please remember to leave a like on it. And if you want to stick around and see more stock market related content like this, then please consider subscribing to my channel as well. Also, please do not forget to go and sign up for our free newsletter that will be sent out tomorrow on that high quality business over at stockunalock.com. All you need to do is enter in your email and you will be receiving tomorrow's free newsletter. And by the way, we do send out free weekly newsletters every Friday morning. So if you want to stay up to date with all of the free newsletters that we are going to be sending out in the future, which are aimed at helping you become a better investor, then again, head over to stockunalock.com and enter in your email to get our free newsletters. But that is going to wrap up the video for today, everyone. So thank you so much again for watching. I truly do appreciate it, and I really hope to see you all again in my next video.